Hello, everyone, and thank you for joining us back in. We are here to talk about IFRS. This is the second of our discussion. I'm Anand. I lead the insurance practice at Tamimi, and I'm joined by Anay. We'll straight away dive into the next set of questions that we had. Anay, if we spoke about what IFRS is, what it covers, what is expected out of insurers. Let's talk about more details. Let's talk about implementation. What do the insurers need to do? What do you think about in terms of implementation?
Right, Anand. Let me take a step back here and talk about the three key methodologies that has been defined by IFRS 17. There are three methodologies under IFRS 17 that is available for the insurance companies. The first one is called as General Measurement Model, GMM. The second one is called as Premium Allocation Approach, PAA. And the third one is called as Variable Free Approach. Now, the General Measurement Model is the one which is by default and model available in IFRS 17 for the reporting purposes. That constitutes four key elements, which are cash inflows, cash outflows, discounting, risk adjustment. So the net impact of these four element is called as either as a CSM, which is the contractual service margin, or the loss component that is getting generated. Now GMM will be likely applicable to the companies which are into the long-term products. Because the requirement is to develop the cash flows, discounting, risk adjustments.
Okay.
To arrive at the contractual service margin. It is a bit of a complex kind of a model which was not available earlier under IFRS 4. So the insurance company need to adjust to that. For the short-term insurance companies, what the standard has done, they have given them a bit of a simplified way of doing the reporting under the PAA approach, which is Premium Allocation Approach, whereby one of the aspect of reporting, which is called as liability for remaining coverage / asset for remaining coverage, is somehow similar to how people look at UPR. It is not exactly the same, but it is similar.
Okay.
So that makes it less complex for the short-term companies, and they could look at their books in a kind of a similar way as under the current regime.
General insurance.
Yes, yeah. But on the liability for incurred claims, another component and the terminology that you will hear more and more under IFRS 17 has remained the same even under the PAA as under GMM. So liability for incurred claim is towards the claims which has already been incurred or they is expected to be incurred. Roughly
IBNR is what
exactly. So roughly, if you want to equate it, it is towards the outstanding claims and IBNR's developments and all those things. There is a third methodology which is called as Variable Fee Approach. This is specifically for the products which share their underlying returns with the policyholder. This is a methodology whereby a certain modification has been done to the default model of GMM, and it will be applicable to the products or to the insurance company which are issuing a product with the investment component. There are certain eligibility criteria that have to see to adopt. So three methodologies available to the insurance company: GMM default model, PA, which is a modification to GMM, and simplified model for the short-term insurance company specifically, and then the VFA. Without going into the much of the details of this, but these are the three key methodologies.
Sure. And we just touched upon it. What is the risk adjustment or the discounting that comes into this?
And as I said, you will hear certain new terminologies under IFRS 17, which is liability for remaining company coverage / ARC. Liability for incurred claims, LIC. Risk adjustment is another new terminology.
Right.
So what this suggests is a measure of how much let's say a company is putting an extra in terms of the risk that they are covering or for the uncertainty period. The variability of an event happening to not happening is something which they have under IFRS 17. They are required to calculate separately and report separately as well. This is more about being providing the information to the users of the financial statement And since the standard will be generally applicable to all the insurance company, so the users could make out and make a sense of, okay, how much of a risk adjustment A company is doing as against the company B with a similar kind of a product. Earlier under IFRS 4, this was not specifically required to be calculated and kept separately, but 17 requires it to be now kind of calculated separately and reported separately as well.
And Anay, I mean, if we then talk about discounting, how do you think that impacts IFRS?
Yes, look, discounting is something which the insurance companies need to take into account in terms of time value of money. Earlier under IFRS 4, that was not so much of a common practice to discount if the claims are taking time, or if cash inflows are to be either received or to be paid over a period of time. So IFRS 17 require insurer now to build in that discounting time value of money, and report it separately. Now there are a couple of approaches insurance companies could adopt to arrive at the discounting rate. There are two approaches, which is bottom up and the top down approaches. And during the implementation phase, we have seen that this is one key area of judgment, along with the risk adjustment for the insurance companies. So this will
this will impact on the ultimate P&L as well, right?
Yes, the longer the term of the contract, you will see the impact of this on the P&L and the unwinding of this over the period of time. So the standard talks specifically on the discounting side as well.
Great. Okay. Now, if we go into the level of aggregation, I think that's another important aspect of IFRS 17.
Yes.
Let's just quickly talk about that.
Yes, Anand. So, look, level of aggregation again is a new concept brought in by the IFRS 17.
Right.
Earlier, the insurers who were aggregating the results in terms of line of businesses, they may now need to segregate this into various level of aggregation as required by IFRS 17. So, in general terms, 17s require an insurance companies to divide their products into a portfolio, annual cohort, and then the groupings based on the profitability.
Right.
So portfolio, what they have defined is to be bringing the contract with a similar nature and managed together, and then segregating this into based on the annual cohort. So any policy which was issued, let's say in 2020 will stay in 2020, 2021 will stay in 2021. And then within, let's say, that annual cohort, the lowest level of aggregation that is required by the companies to maintain is towards the profitability bucketing. So standard require minimum 3 level of bucketing. And which is, first one is towards the profitable contracts. The second one is called as onerous contract, a loss making contract. And the third one is called as remaining bucket, which is somewhere between the profitable and the onerous contract. Where there is a possibility of becoming onerous at a later stage.
That's very interesting. I mean, let's just go into a little more detail about this. So what is onerous contracts? I mean, what would mean in terms of the how do we translate that into real terms?
Anand, I mean, look, that makes it IFRS 17 very much different to IFRS 4. Is one of the aspect of keeping an onerous contract and reporting for it. So essentially what IFRS 17 is saying that, okay, based on certain guidance provided in the standard, you have to identify certain contracts or a group of contracts which are possibly is going to be a loss making or maybe expected to be making incurring a loss. So they had to be bucketed into a separate bucket and has to be tracked over a period until the liability has kind of settled down. The reporting aspect of it, that is also interesting, because now the companies need to book that losses on this contract on day one. So, and they cannot, because of the segregation of how the bucketing is being done or required under 17, you cannot really set it off against the profitable contract. So you'll have to keep this into the separate bucketing and track it separately and report it separately, including in the financial statement. So that's where the earlier point which I said, 17 requires you to move from quantity to the quality, because it's about the risk that the company will be picking up and what kind of risk they will be picking up.
I mean, I'll not ask you this question to maybe because this may put you on a spot, but I mean, the onerous contracts, if you know something is onerous, why enter into it in the first place?
Absolutely. Look, there could be various reasons. One of the reasons could be a business reason, a relationship reasons. Somebody might want to take certain bit, but of course, to have onerous contract there is kind of an indicator at saying that, hey, Mr. Insurer, look into your pricing.
Exactly.
Look into your risk assessment. Maybe, okay, fine, you have picked a certain risk which may be leading towards onerous contract. Just look at the strategy, look at the repricing, look at the various aspects.
I mean, this could potentially change the way they do the business altogether.
A bit of a strategic changes, bit of a viewpoint changes, which may require insurers to look into with this impact of onerous contract.
Sure. Thank you. And I think, I mean, let's just sort of, we're ending towards the, we're reaching to the end of the session. So what do you think are the pitfalls? I mean, where could insurers go wrong, or what are the things they need to be watchful of when they are implementing IFRS 17?
So look, this has been a long journey for many insurance companies. If the insurer are into the multiple products, including short term and long term, and the companies which have have to make a choice.
Those with both would find it more difficult.
Of course, yes, because then they will have to apply all the three methodologies at some point of time at some product.
Yeah.
And then it makes it really complex in terms of what was the information already available.
Yeah.
And how do I translate that information in form of data that will be used for 17 perspective. So in the last couple of years or 2.5 years, what we have seen is that data becomes one of the biggest challenge. Maybe it's because of how the companies have been operationally used to doing certain things. 17 requires them to produce certain more granular information, certain more additional information to what was available, and to tie it back to how this need to be reported using a reporting tool which is available. So that is one area which we have seen is one of the key companies need to look at. Of course, various choices, judgment, there are significant judgment involved. While the standard talks about particular principles, it also gives a bit of a flexibility around certain judgment to be made by the companies.
Okay.
So this is the judgment, and how they have implemented certain principles, policies, the reportings will need to be followed accordingly.
So I mean, what I take away from this is that it while it is only applicable to insurers, it will have an impact on rest of the industry as well. So the broker will probably need to capture more details. A TPA, which is writing health, may have to change some of the methodology in which they capture the information. So I think it'll eventually have an impact on everybody else. So there is an education that's required. And I think you guys seem to be doing a great job at it. And we're hopeful that, our sessions are helpful and it is doing something to that extent. So thank you so much, Anay. And we will come back with another episode. And in the meantime, if, our listeners have any questions or any aspects of IFRS that they would want us to capture in more detail, please do tell us. We're very happy to take that into consideration. And thank you again, Anay. If you have anything.
Anand, thank you for inviting me here, and I have a great pleasure of sharing my experience on this subject matter. I hope it might be useful for the viewers of this video or the audio.
Absolutely, it will. Thank you.